Happy Friday, traders. It is the 22nd of March, 2019. Thanks for joining me. It's 8:02 a.m. here in Chicago in what is a cool, sunny day. Spring cometh. Very happy about that. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. So, risk off sentiment this morning dominating the markets, mainly, as far as I can tell, mainly led by uh, German economic data, uh, causing worry of a recession or global economic, contributing to a global economic slowdown. European markets moved in the red today. During their session, the dollar strong against the euro. Oil prices fell, and Asian markets ended slightly higher ahead of a fresh round of trade talks between the U.S. and China. Excuse me. Um, and so gold prices continue to be supported by this dovish Fed stance that we got on Wednesday. And so this is where the market is. Sentiment overall is towards safety. The laggard today is the Euro Stoxx 50, down 43 points or 1.34%. Crude oil's off 1.32%. Crude oil is at 59.19. The high of the session is $60.07. It's come a long way. The DAX is down 0.83%. Then the Russell's weak. The Dow's weak. By the way, the Russell, on a relative basis, really didn't participate in this run up that we see in the Nasdaq and the S&P. The small caps are just relatively weaker, with a relatively weaker delta. So this is where we stand. The leader this morning, we have a little pop up in the volatility index, up 2.49% on the futures. The bonds are the leader in this in today's move. The bonds are up a handle and 2 ticks. A handle and 2 ticks. That's a lot for the bonds. The British pound's stronger. The Japanese yen is stronger. I guess the EU gave the UK 2 more weeks as a last chance to avoid a hard Brexit and to exit in an orderly fashion. There were no commitments, no strings attached to this extension. There's an April 12th deadline to offer a new plan or choose to quit the bloc without a treaty, which is what a hard exit would be. And so that's really going to start weighing on the markets probably over the next couple weeks. That really there's a looming deadline that isn't that is a hard deadline. Let's take a look at what we expected yesterday versus what we got. Yesterday, the primary scenario, given the way we closed on Wednesday, the primary scenario expected a pop higher into 2830, 2827, and then was looking for the market to actually pull back and push down, test lower into 2808 yesterday. That was the primary scenario with a potential extension to 01 below 2801. Did not happen at all. The secondary is to test below yesterday's range and then get an impulse up and move back up towards 2836, 37. Did not happen. The third scenario is what ended up playing out, but the targets, of course, I cannot predict. Like I've said before, I would be a total liar if I told you that I can predict that there's going to be a 50-point move. Yes, the market's been somewhat balanced and coiling, but there's just no way to say what's going to happen. And anybody who says that they can is a lying. So the third scenario came to the front very, very quickly. I want to just take a moment. I'm not going to spend too much time on this. I don't want this to be an epic episode. By the way, this is this is episode 1482 of the trader bite. That's how many there have been. I went through the archive yesterday, and that's what it comes out to. About 1,300 of them, or 1,320 or so, are on YouTube. Others, I used other media to get those out at the beginning. But take a look at this. We open, we hardly push lower at all, and then we get this big move right off the open, right? We get 12 points, something like that. Let's see, zigzag, 11 and a half points right off the open. That's an impulsive open. It's not normal for this product. And how do I know what's normal? It's because I'm tracking statistically through Convergence market cheat sheets, market stat sheets. We track statistically what it could be construed as a 1 standard deviation move versus a 2 standard deviation move, and so on. I'm not using VWAP or anything or moving average with standard deviations, although you can approximate it with that. But overall, we have an impulsive move right off the open. Just a huge caution to shorts, huge, very early on. And the line in the sand is going to be around 28, 36, 37, right? That was the initial target or the initial turning point expected. So that's the line of the sand in the sand. So if we don't get a good response up here and we keep pushing through, then you need to stay off of shorts. Now I'm going to tell you this, having watched a couple thousand accounts at a brokerage that where I was watching risk and watching how people trade and intervening and trying to help online traders, um, trying to save them from themselves. I can tell you that, you know, helping someone avoid being on the wrong side goes a long way, in my opinion, goes a whole long way towards giving them the gift of time to make the turn, to actually succeed in trading. So why am I mentioning this? I'm mentioning this because if I can get you as a Convergent member or listener or whatever, I can't do it because the Trader Bite's not done when the market's opening. But if I can get you to just not get short so that your entire focus is on finding a long by simply identifying early on, as soon as this happens, the first 6-7 minutes of trading, identifying that shorts are toast, this would go a long way towards easing your frustration. But I found that when I discovered this, when I'm able to see a market and identify, which is a big piece for me, for my consistency and durability in this market, is to do my best early on to use some areas, some things, some factors to define what kind of a day it's likely to be. So is it a push right off the open? Is it a balanced open auction in range, out of range? Is it a balanced open so I know that I can potentially trade both sides until the market goes from balance to imbalance and breaks one way or the other? But days like yesterday are relatively rare. They've become more common lately. It's jumped from about 17, 18% to somewhere around 24 to 26% that we get these trend days. Trend days defined as a market that exceeds double its IB and in general does not have consensus and closes near the extreme. And so, you know, a market that's one time framing up as well. So to me, just avoiding the short side just frees up, let's say, half your energy is now free and can be reallocated to just finding areas to get long. So if I can get you to just put on a lens that can only filter for trades that help you get long, I believe I've gone a long way towards helping you stay out of trouble. And this is the point I want to make. When you have an open like this, where the market just does not even attempt to touch the low below. The prior day's low was not far from the open. Just a couple of points, really, 3 points. You would think it would be an open test drive, that's scenario 3, push to 37, 36, 37, pull back, push through, pull back to the 37. Oops, my mouse slipped. Pull back to the 37 and then continue higher, right? That's scenario three as provided here. That's what you see there, okay? In the cyan, in case you're lost. This guy, okay? So just being able to focus from that side would really help traders just calm down, wait, and know that they know it has not gone too far. No, this isn't a huge level to sell. No, it's the bands are not stretched. No, the RSI is not at 90% and can't go any higher because the RSI, when it gets above 80% or so, it cannot move very fast upwards as the rally continues for another 100 points. Things like that. Those are really mean reversion type tools. Just know what kind of market, knowing early on what kind of market we have and what kind of push is occurring is really huge towards helping all of us as traders just stay on the right side or sit on our hands. Sit on our hands, save money, be here tomorrow. That's the ultimate goal. The ultimate goal is survival. And you cannot survive by fading a move like yesterday. I mean, the risk alarms probably were going off, for those few brokers who actually care about their customer risk alarms are probably going off across the planet yesterday with traders wanting to short something that's gone too far because they want to be in, but they can't buy it. It's gone too far. So yesterday, this is what we've got. We've got a clear, clean trend day. You can see the migration of the auction. The auction just migrating up, up, and up, and up, and up. The point of control yesterday did not have a chance to move to the high of the day, and that's interesting because normally we would see the point of control up here in the upper distribution, which would give us the fuel that's likely to cause a pop overnight. But because the point of control remained down below, there's less statistically, there's less of a chance of that happening. And that's exactly what we saw, where the overnight high was actually below yesterday's high of 2866. 2858.75 is a big area. Big area. We broke through it. We fought. Look at this fight. Holy cow. That is some grind right there. We fought through it, and then that became the floor beneath us. So overnight, once we fall back through, that would be an area to sell if you're trading the overnight session. Hindsight, of course, is always 2020. But this is a trend day. There's no consensus on price. There's really no value area. How do you define value in a market that's constantly seeking higher prices? There is no such thing as value, even though the computer can compute the black area and tell us what value area is. It's nonsense. This is a trend day. So what's the habit for most products, most liquid products? What is the habit after a trend day? I can't wait for your answer. I have to keep talking. But the habit is to rest. Once the market sprints up a hill, right? This is what it did yesterday. Excellent delta yesterday. Excellent. Just very strong delta. We haven't seen this high a delta since November 15th. And of course, November 15th, the following day, did as expected. Go back and see what November 16th did last year. As expected, we have a rest day. So today we're opening in the middle here, 24.8550 on a very elongated profile, and it's likely to rest. So that's the expectation for today. So that was yesterday. So scenario three, of course, my targets were too modest. 28.58.75 was just the big key yesterday. One-time framing down ended abruptly, and now the market's in a neutral territory, and it's got to figure out what it wants to do today. So the overnight session goes sideways, goes pretty much sideways for a period of time, sells off a little bit, goes sideways some more, and then the Europeans come in right in here. A nice little attempt to go back to the prior day's close in this product, and then boom, all this news out of Germany and so on. And what we have here on the 15-minute in the extended hours is an impulse. This is the impulse right here, big move down. And then you have the flag, either a bull or a bear flag, right? This is the pullback consolidation. This is where I would normally look to get in. That pullback is my playground, and then the continuation right here, okay? And if the continuation is so large that it exceeds the impulse, the length of this impulse, right? If it exceeds the length of this impulse, then this becomes a secondary impulse, and the expectation is consolidate for continuation. We expect the continuation to be shorter in distance or range than the impulse, and then we start to get, then we're off of the shorts in this situation, and we back off of shorts, and then we're looking for corrective. We look for a push up, a high pullback, and a corrective move back up. Typical pattern. Elliott was built on this kind of idea. It's ancient. But the overnight session shows us two distributions. One is uneven and one balanced. We have a balanced distribution. We have a low that is fairly, we have a low that's fairly poor on the overnight session, and we have a fair amount of volume that's being held up here at 2850. 2850 acted as a collision zone several times yesterday. I'll show you the heat map for those of you who don't have it. But if we go back, oh, I don't have that data anymore. But 2850, in fact, we see it right here. This liquidity right here at the mid-century figure at 2850, beware of this. This liquidity keeps coming back and it keeps trading out. And it was doing that yesterday. We had a beautiful collision at 2850, pull back, push through, pull back to the 2850, and then continue just an excellent opportunity to be able to get long off of that liquidity. Boy, I tell you, I wish this software existed when I started trading futures in 2002. I would be much better off just to be able to see where the long-term intent is to trade versus the actual, which is what's on our charts. Anyway, let's move on. This is taking too long. So let's take a look at the current situation. The current situation is we have a couple of numbers coming out today. We have the market composite PMI. Those are 15 minutes in. Fed's Bostic is talking right at the cash open, the U.S. cash open, and then 15 minutes later we get the market composite and services as well as manufacturing. This may or may not move us. These numbers can mean something. Then we get wholesale inventories at the top of the hour, a half hour in, along with existing home sales. And those are likely to be movers. Then we get the monthly budget at 2 o'clock. So be aware, 15 minutes after the open, a half hour after the open, and then later on at 2 o'clock we have numbers. The monthly budget statement doesn't really shift us around. It's a macro type of release, and huge deficits despite these tariffs. We've had our worst deficits, in case you weren't aware. We've had our worst deficits ever in the last month or so. The tariffs are supposed to alleviate that and fix that problem. They're not, because, you know, economics and all that. And so let's take a look at what we're expecting today. Again, you get the benefit of these stock zones remaining here. I keep forgetting to remove them because they're proprietary. So what are we looking for today? Well, guess what? I want to ask you to take the time today to make sure you hit the like button on YouTube. Find it on the YouTube channel. If you're looking at this on the Convergent website, then click YouTube at the bottom right of the video and go there and hit the thumbs up if you can, please. So what are we doing today? Today, what's likely to happen is we're opening right against yesterday's mid, right against that 40 area, the IB high. It is likely to be a fairly noisy open. We do have this key high from the FOMC. So the key figures today are the high from the FOMC, 58 again, 58.75. And then below us, we do have the 36 remaining. Okay, and anything below there actually gets us into the thin part of the profile. So let me show you that for a second, just on a traditional market profile chart. This is yesterday. Let's shrink this and show you what yesterday looked like. That's yesterday. This here is yesterday. Each one of these boxes represents a 30-minute bracket. Now, this is what's called a buying tail. This is a really strong indication that the market is moving away from price. You could see it opened and it ran up. So the first bracket, the B bracket, the first half hour really ran away from the open. Again, that's our clue to back off of shorts. Now, where does the second bracket overlap the first bracket? It overlaps it right in here. And that's right below the 36, right below the 36. So anything below 34 and a quarter, 34 half, you want to lay off of longs. You want to just back off of longs. So that's just a clue in from market profile. We could see that in the volume profile as well. We can see that it's starting to get thin down in here. It's starting to back off. Down below 36, I don't want to get long, but the key area is below 36, 40. The key area above is the Fed high area, the 50. Remember, it's got that liquidity, and 58 still. So we're opening here right in between, right in the center of everything against the point of control. Open auction, expecting it to test higher, hold steady here. I'm looking for an attempt down into the 40. And then it's likely to push through this 50 area, consolidate, and hold steady here. Probably 12 to 14 points of range today is what we're likely to get. It's a rest day. It's a rest day, and so it's likely to not make a move. Now, does that mean that you're going to fade these levels because you think it's a rest day? It might turn into a trend day from the middle. Some global macro traders get in there and they're pushing for, 2,900 or whatever because they think that's where value is and they'll buy anything below that. I don't know. But that's the key plan for today. I expect it to have some rest. Secondary, I'm looking for a test up, a push up that looks successful against the 50, an impulse down that gets us below 40, and then it starts to move below 36, and then we start to tackle yesterday's low to finish somewhere in the lower half of yesterday's profile. Okay, there's a chance here for an open test drive in either direction. The most likely open test drive would be scenario 3, and that'll be to the upside. So we would be seeing or looking at these levels as we push down into 40, and then we push up, and then we start to move back to the upper distribution and hold near the highs of yesterday. That's the third scenario. Why am I speaking so fast? It's because the market's doing something to talk about. For the last 2 weeks, there really hasn't been anything to talk about. Trend days I don't like trend days. I think many do because they're kind of momentum traders. I'm not. These kinds of days give us clues as to what the market really wants, and so it gives us a lot of ideas on what we can do with that information. Key resistance, again, 58.75 area above. It is Friday after a trend day, likely to rest, likely to be choppy. But as you know, as I know, the markets will do whatever the markets want to do. There's no way to exactly predict it. We just respond to what we see. And because it's Friday, you don't want to sit there and bet the house, okay, and end up with a weekend that's messed up because you just were acting stupid and lost too much on your bets on Friday. Set limits, set rules for your risk first. Your goal is to survive today so you can be here tomorrow, so you can have a chance at making something out of this career. Good luck, and I'll catch you tomorrow. Don't forget to like. Take care.